Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schlein.
Hi, this is Eric Schlein. You're listening to the Intelligent Investing Podcast, our coronavirus investing series. And today we have on Shelly Lombard, who runs MilleMoney. She also worked as on Wall Street for about 30 years. Her specialty was in junk bonds and value equities in distress situations. And Shelly, welcome to the show.
Thank you. Glad to be here.
Yeah. Now, you also, if I'm correct, you do some guest lecturing at Columbia Business School as well.
Yeah, I do Columbia and Wharton. And so I'm doing a lot of, they have executive education programs. I got my MBA at Columbia, but I also do some guest lecturing at Columbia and Wharton. And then I also teach some special classes in investing for, hedge funds, et cetera.
And my dad got his MBA at Columbia through the executive education,
Okay.
Yeah, cool. Very cool. So tell us a little bit about, I gave a little rundown, but tell us a little bit about your background on Wall Street and kind of, how you started your career. Just give us a little background on who you are.
Sure. So I was a journalist before, just for a few years right out of undergrad, and decided I wasn't happy doing that, decided to go back to Columbia and get my MBA. And I have to say, I was lost. I was used to being a really strong student, but a lot of the people in the MBA program had worked on Wall Street for 2 years as analysts and then come back to get their MBAs. And so just basic concepts like present value, what is commercial paper, stuff like that. I just had no clue. I was lost. So I really had to, baby accounting for me, they called it baby accounting, but it might have well been space accounting as far as I was concerned. I mean, it was just really, really hard for me to grasp some of the concepts. Right. But you really learn a lot of this stuff on the job. So my first job out of business school was at Citibank doing leverage buyouts. And that's where I learned to model, and I learned to value companies, and I learned how people think about this kind of stuff. And eventually I found my way into being a junk bond analyst and a value equity analyst. And the reason I do both is because if you do junk bonds, sometimes the debt gets converted into equity if the company is really in trouble. So then I had to figure out how to value equities in companies that were, exiting bankruptcy or potentially going into bankruptcy. So I, ended up doing it for probably about 30 years. Right now I'm doing a lot of teaching, and I just launched MilleMoney for novice investors, because, when people learn that I worked on Wall Street, they always want to ask me, what do you think of Tesla? Should I buy Netflix? They always want to ask things like that. And a lot of times they need really basic information. So, for example, my daughter, who, you assume picks up this stuff through osmosis, had some of her 401k in money markets. And I was like, no, not the right vehicle for your 401k. So anyway, so I started MilleMoney for novice investors, but really this kind of bear market is really the kind of place that I cut my teeth. So I really like talking about that as well, about, how to look at companies in this type of environment.
Yeah, well, I think it's interesting and timely to have you on when we're having you on. We did an episode in December with Jeremy Raper on credit-based equity investing. And, just from some of our previous conversations, you certainly have a similar way of looking at equities in that manner. And I think it's especially important today where, one of the analysis is just figuring out, okay, is this business going to be around in a year, or is it going to be around, but the equity is going to be wiped out? So,
right.
So can you tell us a little bit about, your approach to when you're looking at a security, whether it's a bond or an equity, kind of what is your approach to looking at assets?
Sure. So, I just want to reiterate what you said. We're coming off of an environment where it's been pretty easy to raise money. And, pretty much if you had a pulse, you could raise debt. You could issue bonds, junk bonds, et cetera. And so companies, I think, have a lot more leverage than they went into this bull market with. And so obviously, coronavirus is an issue now because people, rightly so, think it could lead us into a recession. And, there's a question of whether whether, I think some people thought it might be a V-shaped recession. Now it looks like maybe a U recession if we're fortunate. If we're unfortunate, it could be an L. The country goes into a recession and kind of stays there. So it's really going to test people's balance sheets. And so like people, the amount of debt you have and the liquidity you have going into a troubled environment is really key. And then also with companies, it's your business model. Do you have high fixed costs, et cetera? Just one thing before I kind of, talk about my approach.
Sure.
Houlihan Lokey, which is a firm that advises companies that are restructuring, either before they go into bankruptcy or once they're in bankruptcy, said they really expect default rates to be higher than they were in 08 and 09. Companies, and even if companies don't default, that could be an environment that leads to very volatile equity prices. Because, we all know equity values, just like the equity in your house, goes up and down depending on the value of your house. The equity is the first thing to get volatile if people start getting concerned about the company. So even if you don't think the company is going to file, equity prices could be volatile. So that credit-based approach, which kind of, I almost didn't have any choice but to do that because I grew up in the debt markets, like, making loans for leverage buyouts and then being a junk bond analyst. I think of everything in that way. And so I have a certain approach. So I'm happy to talk about that. I guess you guys pretty much coined the phrase, a credit-based approach to equity investing. And I saw that and I was like, yes, that's exactly right and exactly, appropriate for what we're dealing with today. And I guess it's credit analysts are much more used to looking at the potential downside, just because on debt, you have a little bit of upside. Maybe it trades up, maybe if interest rates are going down, the debt trades up a little bit, but you have a lot of downside. So in 08, 07, 08, even earlier than that, I was covering the auto industry and I covered General Motors. And there were people who bought General Motors bonds at, 100 cents on the dollar, which is what you pay for bonds. And they were still in it when those bonds were down in the 30s. So if you had $100 million, a pretty typical investment grade fund might have $100 million in GM. If the bonds went from par, 100 cents on the dollar to 30 cents, you've lost $70 million. That's a lot of money. Right. So, bond holders and, credit people are used to looking at things like what's the downside. So I think that's an appropriate way to look at, some of these situations now, just because of the kind of environment we're going to. So I'm happy to kind of, walk through my approach a little bit.
Yeah, maybe we can go. So I think, you're such a veteran on Wall Street. I think it would be interesting to maybe go through like one or two prior case studies and things you actually looked at that make for a cool story, and then maybe one or two things, in the given environment today that you're looking at and kind of go through your thought process. Would that work for you?
Sure, that'll work. So, companies run into problems when they run out of cash or look like they're going to run out of cash, if they can't refinance an upcoming maturity, or their banks or their vendors get nervous and the banks, don't want to give them any more credit, or their vendors don't want to ship. So, two stories from, the 08 kind of time frame. So one turned out well and one didn't. So one is Goodyear, and Goodyear makes obviously tires. And the problem they were having then, opposite to now, is that gas prices were high. And so people weren't driving as much. And so, tires are not a discretionary purchase. Like you don't wake up one day and decide, oh, I'm going to go shop for tires. Like you only buy them when you need them. And the only reason you need them is, it depends on how many miles you're driving. So if people have cut back on the miles that they're driving, they're going to eventually need tires, but they won't be replacing them as quickly. So Goodyear bonds, were kind of still, they weren't trading at really distressed levels, but the stock had gone down to like single digits. Maybe it was $5 a share, something like that. So the question was, one, did Goodyear have enough liquidity and money to make it until oil oil prices came down again and people started driving, because what people were doing, they were taking public transportation, they were, sharing rides, et cetera, because nobody wanted to pay, fill up their tank at $4 a gallon and even higher in places like California. And so, a couple of things you had to look at with Goodyear was, did they have the liquidity to get through this? Nobody knew when gas prices would come back down again. Did they have the liquidity to get through this? Did they have any ability to kind of offset this decline in volume until, gas prices turned around? And I guess the answer to both of those things were yes. So, I looked at their liquidity lines, their amount of cash, what kind of cash burn they had. So it looked like they could make it through the cycle. But the other thing that was really helpful is, one, there's no substitute for tires. And when you need them, you need them. So it's kind of what we call inelastic demand. So that was helpful for them. They controlled their own distribution. They have their own Goodyear tire stores. And in addition to that, management was very smart. So a lot of it comes down to management. And what management does, they decided if they couldn't sell you tires more frequently, what they were going to do is sell you a higher price tire when you came in. And I didn't understand it when they first started talking about it, but essentially that's around the time they introduced the run flat tire. So, they'd have these commercials where you're driving with your family on this dark, desolate highway, and you get a flat. Well, the run flat tire enables you to drive another 50 miles on it until you can get to the next gas station. And so they couldn't make you buy tires sooner than you needed to, because you just, why would you do that? But when you did finally come into the store, they sold you a higher price tire. And so Goodyear was able to make it out of that. I was a bond analyst at the time, but I actually recommended the stock. I got to the party late. I was like, I wasn't a believer at $5-6 a share. I think I became a believer in the company and what management was doing at maybe $9 a share. And I think it rallied, to the mid 20s.
What was the valuation of the company around 9?
You know what? I don't remember, because it was over 10 years ago. Yeah. So I just don't remember. That's a good question, but I don't remember. It was just too long ago for my memory. But it was, and I certainly did it like what bond analysts tend to do is an EBITDA valuation, because obviously you're valuing the enterprise, not just the equity. So I didn't do a PE multiple or anything like that. That was kind of out the window at that point, because earnings were kind of all over the place and multiples were kind of all over the place. But I did an EBITDA multiple. Then you get the enterprise value, you subtract out the debt, and then you have the value of the equity. And I was really comfortable with the value of the equity, ended up recommending it, and it turned out, well for people. At that time, I was working for a research firm whose research was purchased on a subscription basis by hedge funds and people who were doing, proprietary trading, investment banks that were doing proprietary trading. So that worked out well for people. One that didn't work out well for people was General Motors. So General Motors, similar problems. Gas prices were high, so people were making the decision, rather than buying cars, rather than buy SUVs, they wanted to buy hybrids and passenger cars. So they had two things going on. Not only were gas prices high, but the economy was relatively weak. So people were, kind of scaling down, buying less expensive passenger cars that didn't use as much gas, hybrids if they could get them, or they were delaying their purchases of cars altogether. So that exposed a lot of problems with General Motors. So unlike Goodyear, where there's no substitute for tires, General Motors, and Goodyear had obviously competitors, Cooper Tire, Bridgestone, et cetera. Sure. But General Motors had competitors that had a better reputation for quality than they did. So there was Toyota, there was Nissan, there was Volkswagen, et cetera. And they just had too many nameplates, for lack of a better word. So at that point, GM owned Saturn. Ford owned Jaguar. And so you've got to spread your advertising dollars over all these different vehicles. And so that ushered in a time when General Motors said, we just need to restructure this company altogether. What we're doing is not working in this new environment where people are buying new cars less frequently and they're scaling down. And you know what? It doesn't cost that much more in labor to put together a car than it does at an SUV. But that Ford Focus might cost, $20,000, and that, Ford Navigator or whatever might cost $50,000. So it's a big difference in price. So that didn't work out well for people because the equity got wiped out. General Motors was just slow to get off the mark and kind of restructure. It's kind of like turning around an ocean liner in a stream. It just took them too long to get stuff together. They ran out of cash. They had to be bailed out by the government. That saved the company, but equity holders got wiped out and bondholders recovered 30 cents on the dollar. So, not having enough liquidity was a big thing. When I first started looking at General Motors, they had enough liquidity, we thought, to get through a couple of years, but the cycle turned out to be much deeper and last a lot longer than we thought. So we thought, in a year or two, gas prices will be back down again. People will be back to buying their SUVs and General Motors will be fine. And it didn't work like that at all. And one thing it exposed was General Motors problems. So, one thing I would say to people is, and I always say this when I teach classes, a lot of times these cycles, these down cycles, expose problems that the company had before, and this cycle is going to make it worse. So, with retailing, for example, brick and mortar retailers have been under assault for a while. But now, in this environment with COVID, people are buying even more than ever online. People who've never bought groceries online are buying groceries online. So what that means for retailers, brick and mortar going forward, it's accelerated that trend to online shopping, and that has implications for retailers. So even though, to make the assumption that, earnings are just going to bounce back to where they were before COVID may not be a valid assumption because, the buying habits have changed forever. And so that's something people really need to look at. I looked at a distressed retailer the other day whose name I'm not going to call, but the stock is really beaten up. It popped up after earnings, probably because it was short covering. But again, I think it's changed. Retailing is going to be changed forever. And so that's, So I think, just in terms of the macro or the qualitative analysis, is something that's really critical when you're looking at, equities in this environment. Right.
So what are you looking at today that's interesting?
It's a tough one. I think I've put a little bit of money to work. But not a lot, because I think the market has another leg down. Who knows? Nobody has a crystal ball. Sure. The best thing and the smartest thing to do is invest either, monthly kind of dollar cost averaging, or, it goes down 10%, you put some more in, then it goes down 10% and you put some more in. A couple of things that I have in my portfolio that have been hit the hardest have been Disney. Because of the whole theme park thing. I didn't buy more of it, but I still like it. I think it'll be slow to recover because I think, people are going to be afraid of crowds, et cetera, for a while. But I owned Disney before the crash, before the bear market got ushered in. And, I'm like everybody else. I'm not, I think it's a bad idea to sell it. I own Amazon, owned it before the crash, and I still like it. I own Take-Two, which makes Grand Theft Auto and video games. That one has performed pretty well. One name I went into for the first time, and now I'm like, I won't say I'm having second thoughts, but I've always liked Starbucks. I got in it, then I got out of it, and it kind of rallied, and then I didn't get back in it. I think it will be a name that will recover quickly. And one of the things to think about is who's going to recover and recover quickly. Just because I think when they they finally let us out of our houses, we'll be running to, like, we might not be running to take cruises or, running to go to, a theme park and take our kids to a theme park. But I think we'll be like, I can go to restaurants. I can go to my local Starbucks and get a cup of coffee. But I think that's going to be a tough one. If you look at their leverage, they have borrowed a lot in the last couple of years to do stock buybacks, the infamous stock buybacks. And so their debt is a little bit higher than I would like. And they're being very good to their employees. They closed all their stores in China. I think they're starting to reopen some of them. But they have been very generous to the employees, as they should be. And that's a great, that's a great corporate citizen kind of move. But that's going to hurt their earnings. I think they can mitigate a little bit because they have drive-through. So you don't have to actually go into the store and, stay and hang, and they probably wouldn't let you do that anyway. But something tells me when when this is over, people are going to be dying to get out of their houses and go do stuff like, have a latte at the local coffee shop just to get a different scenery. So I like Starbucks, but I would probably be a little bit cautious just because of their debt load. They're much more highly leveraged than they were 2 years ago. And, leverage is not. Now, look, they still have, as a bond investor, I tend to look at things like, EBITDA to interest coverage and, just how well they can pay their debt. But I think one thing you got to remember that all these ratios are backward looking. So I think this first quarter is going to tell us a lot, like how much cash they burn through, and that cash versus their cash position and their credit lines is going to tell us a lot. And so that's one of the things I look at. And, if you want me to talk a little bit about, cash and cash being king, I'm happy to talk about some of the ratios and some of the things that I look at, that you may not look at as the typical equity investor, but I look at it because I can't help myself because I'm a bond investor.
Yeah, no, please go ahead. What are some of those ratios that you look at?
So I look at what's called cash from operations. It's not a ratio, it's just a number that you would pull off the company's cash flow statement. If you use, and I like to use, I just discovered them and I'm a big fan, Koyfin, KOYFIN.com. It's a site where you can pull down financials, and they do some of the work for you. So, you not only have the gross margin there, but you have the gross margin percentage, So I just discovered them, about 6 weeks ago, and I absolutely love it. They make it easy. I don't have to calculate my own ratios. They calculate a lot of them. But if you pull it off Koyfin or whether you pull it off the 10K or the 10Q, you want to see a company that has positive cash from operations. And that's the number that's kind of in the middle of the cash flow statement. In other words, it's basically net income and it adds back and subtracts out things that we don't often think about, like working capital, stuff like that. If you're a company that builds inventory, then that working capital number is important. If you're not selling inventory, it's just building and sitting there. So cash from operations incorporates that number. So I look to see that a company has positive cash from operations and that number covers their capital spending. And their capital spending is the amount they spend to stay in business. So for example, when I took over General Motors, it was an investment grade company. And I looked at it and basically the auto operations were not generating enough cash to cover the CapEx. And that's a heavy CapEx business. It's plants, it's equipment, it's tools, et cetera. It wasn't generating enough cash from the auto operations to cover the CapEx they needed to spend to develop new models and stuff like that. Not talking about R&D. I'm talking about investing in property, plant, and equipment. And I remember thinking, how is this thing ever investment grade? Well, what was happening was their finance company they were making a lot of money, basically making people car loans. And so that was kind of masking or allowing them to continue to kind of motor along with the auto operations not being as profitable as they should be. So I look at cash from operations versus CapEx again. This is a look back, but if that's been bad historically, going forward, these guys have a problem. So even though that's a look back, if you look at their last 10K or you pull up their numbers on Koyfin or, some other site, and cash from operations is not enough to cover the PP&E, that the property, plant, and equipment they need to invest in their business. Historically, it wasn't covering it. It's just going to get worse. So that's a problem. And maybe that's a name that you would avoid. On a going forward basis, what I like to look at is cash as a percentage of debt, because that kind of lets you know how liquid they are. I will often look at cash and receivables versus their current liabilities. So cash and receivables, that's, receivables are something that will turn into cash quickly. And I look at how much that covers the stuff that's going to be due in the next 12 months, which is the current liabilities. That's the current portion of debt and other stuff like that. And then I also will look at upcoming maturities. People get into trouble because they either run out of cash, as I said, or they can't refinance upcoming maturity. So if a company doesn't run out of cash, but they have a big, $1 billion of bonds maturing next year, that might be a problem because the capital markets might not want to refinance that debt for them. And so I look at, cash from operations versus, CapEx, which is spending on PP&E. I look at cash as a percentage of debt. I look at if they have any upcoming maturities. And I also will look at their credit lines. And you've probably seen the headlines. A lot of companies now are borrowing as a preemptive strike, just going into their bank credit facility and just borrowing in case they can't do it in the future, just so they can make sure they have liquidity. And that's probably a wise move. I don't think the banks are in trouble like they were in 08 or 09, but I think that's probably wise to have that cash on hand. And so those are some of the things. Some of them are ratios like cash and receivables to current liabilities, but some of them are just, number like cash to debt is a ratio, but, credit lines, upcoming maturities, and, the historically, if they've historically been able to cover, PP&E from cash from operations, that's a big one for me, because if they weren't able to do that in a healthy, strong economy, then that's a problem going forward.
Right. Are there any distressed bonds that you're looking at in this environment?
Yeah, distress. I think there's going to be a lot of product. I think what I will say is I think distressed investors are they're based, I won't say they're on the sidelines, but they think like a lot of equity investors, there's another leg down. Now, equity is a lot more liquid, so you can do something like, say, I'm going to put on a small position, and then next month, or if it goes down another 10%, I'll put on some more. Bonds are a lot less liquid. So a lot of times you want to wait. You definitely want to kind of phase yourself in if you can help it, but you don't have that luxury as much as equities do. So I think distressed bond guys are a little bit more cautious when they put on positions. So I don't see a lot of people running to necessarily put stuff on right now. They're more like waiting, whereas equities you kind of don't. Like I ended up buying Starbucks anyway, and so I bought Starbucks, and I'll probably buy some more if it goes lower. I'm aware of the concerns, etc. But we'll see how it goes. But I think distressed bondholders are a little bit less. They a little bit more cautious just because they may not be able to average down if they want to, because the bonds are a lot less liquid.
What if say there's something trading at 38 cents on the dollar and you go, okay, let's say this thing goes on for another year and maybe there even is a bankruptcy, I can reasonably get paid back, 50 cents on the dollar. I mean, are there situations like that you see at all?
You know what? I can't think of any off the top of my head. I probably look at one distressed situation a week. Mm-hmm. What I will say is, and I do some work in addition to my own website. I do some work for a high net worth family that I look at investment ideas for them. And I also use a lot of cases in my regular work. When I do my lectures, etc., I do a lot of cases. But what I will say is, I think you need to be really careful with some of the situations now, because a lot of the companies, so we've come through a very healthy economy. Right. And so if a company is distressed right now, not once it gets to COVID, that's a different thing. But one of the things that if it's distressed right now, or it was distressed the last year, it's not because of the economy, because the economy has been very strong. It's distressed because basically there's a problem with the business. So in my line of work, we used to say good company, bad balance sheet. So when I was doing leverage buyouts, buyouts, it was, oh, this is a good company. They just have too much debt. Now you see a lot of marginal companies. And I'll give you an example.
Yeah, please.
So they're not bad companies, but, the competitive landscape has just changed out from under them. So, for example, I'll give you a current example and an old example. So when I was looking at high yield bonds, I covered auto. I also covered media, some, names like crossover names like Sirius XM, kind of auto and media. And I covered media. Radio was one. Yep. So there was a huge leverage buyout done by a very smart private equity shop. And they levered it way up. And I think leverage was like 15 times or something like that. It was a lot. And so a lot of debt. And the first year was tough because earnings and EBITDA in particular, there weren't really any net income to speak of because of all the interest expense, but earnings were really coming in lower. EBITDA was coming in lower than they expected. And everybody said, oh, it's going to be okay because we're just coming off a weak economy. Advertising is low and it's going to come back. Well, what really had happened was the ground had shifted out from underneath them. So the reason this company, this private equity firm, was willing to pay 15 times EBITDA for a radio operator, not just one station. It's basically iHeart Radio. It used to be Clear Channel. Now it's iHeart. They were willing to do that because radio stations used to change hands. You could buy them and sell them for 15 times or less, a little bit less, but 15 times EBITDA, which is high. But the thought was these guys have an FCC license. Anybody can't just set up a radio station on the corner somewhere. You got to have an FCC license. But what had happened was in the interim, and I think they started running into trouble maybe 2010, something like that, is then all of a sudden you had Spotify and you had Pandora and you had people listening to music in their cars, that was downloaded onto their phones. And you had, traditional radio was less attractive, and not just to listeners, but then it became less attractive to advertisers who not only had the ability to advertise on radio, which had been a mainstay, but they could do mobile advertising. They could advertise on websites. They could advertise on Google. So all of a sudden, radio stations individually were not changing hands and being bought and sold by people at 15 times EBITDA. All of a sudden, multiples basically got cut in half. So now they're probably trading at 8 times EBITDA, something like that. And so that is a situation where I think the last couple of years in distress, you had to be careful because everybody assumed that iHeart, which eventually they kind of stayed on the respirator for almost, 9 years. I don't think they ended up filing bankruptcy until last year, I think. But, it wasn't that, advertising revenue was going to come back. It was never going to come back because something fundamental had changed in the business. So what I would say to people is you need to be careful. And I think a lot of the reason I'm hesitant to throw out a bunch of distressed ideas is just because I think that in the last couple of years, I think people have been, a lot of the businesses that the bonds are trading at 30 cents, it's because there's a problem with the business. So I'll give you another example, and then I'll give you a reason. Well, these are both recent examples. One is a dairy producer who recently filed bankruptcy, Dean Foods. And if I could remember any of their brand names, you probably, are familiar with them. They make butter and cheese and a lot of milk. Well, when's the last time you heard somebody saying they drink milk? Everybody's like, oh, I don't do dairy. It's oat milk. It's, soy milk. It's whatever. They didn't branch out into any of those things, and they ended up filing bankruptcy. I think it was the end of last year. That's a really hard company to value because EBITDA is just sliding down because people's habits have changed. And there's something unlike Goodyear where there's no substitute for tires. In the case of regular cow's milk, there are a lot of substitutes. And so even if you're somebody who doesn't have a problem with dairy, you're not lactose intolerant, you still don't mind putting some soy milk in your coffee. So that's a problem. So I think distressed investors have been wrestling the last couple of years. And then one other example, I talked about radio, I talked about Dean Foods, Senveo. It's an envelope company. And I think Dean Foods, I think those bonds got down into the 30s or 40s, something like that. But, and there's probably value there. you've got to do is make some estimate of where EBITDA kind of normalizes. And that's hard to do in an environment where demand just keeps coming down and down and down. I think the other example I was going to give, well, newspapers is similar to radio, but Senveo is a situation where they make envelopes. And they print stuff. They're a commercial printer and they make envelopes. Well, the problem is, like, who's printing anything these days? Nobody hands you a brochure anymore. They say, go to my website, and then in terms of envelopes, everybody's going paperless. You pay your bills they send you the bill online and you pay online. Like, there's no such thing, as putting a check in the mail anymore. So Senveo is another one where there's a substitute for what they do. And it's basically online. And so they really, some of their bonds in bankruptcy have been valued as low as 2 cents because nobody knows when the deterioration in earnings stops. So I said all of that to say, I think it's kind of similar to what I was talking about with your equities. You got to look at it and make sure, there's nothing fundamentally changing with the demand for their business. But the problem with a lot of the distressed bonds that we've been seeing the last couple of years is that something fundamental is changing with the business, and those are a lot harder to value. So even people like me who have been doing it for years have been struggling with it because they're just, it's not like, I'll buy the bonds at 50 cents. The company's going to restructure in bankruptcy. The bond's going to be worth 80 cents. I'm going to collect interest along the way and I'm good. That it's not, it used to be kind of shooting fish in the barrel, and it's not like that anymore.
Right, a lot harder today.
So it's a lot harder today. Yeah. And, had I known we were going to kind of get into distressed bonds, I would have maybe come with some examples, but I'd hate for people to kind of go in that direction with distressed bonds. And look, by the time the bonds get distressed, the equity is wiped out. So it's a different kind of company, so with Goodyear, for example, those bonds never got particularly stressed. They got down to maybe 97, which is why, as somebody who was, looking at stuff for hedge funds, I wasn't recommending the bonds because they didn't care about 3 points. They're going to go from 97 to par and they're going to collect like a 6% coupon. Nobody cared. So I recommended the equity and it turned out really nicely. So I think it's kind of, I won't say it's two different worlds. A lot of the analysis is similar, but if you're looking at straight equities, then I think a lot of the analysis is similar, but you have, depending on the kind of company it is, you may have a little bit less risk than you have trying to figure out, whether this bond that's trading at 30 cents on the dollar is actually worth 50 cents or 60 cents. I think, you have a lot of, even though Starbucks has some leverage and that kind of stuff, I think, and look, I could be totally proven wrong because who knows how long this recessionary environment is going to last and who's going to take it down. But what I will say is there's no problem with Starbucks' business model, right? Because it's been, so they might have, maybe leverage, that might give me pause. And look, if you look at their EBITDA to interest coverage, it's still something ridiculous, like ridiculously high. And, their leverage is something that's ridiculously low. It's just higher than it used to be. But I don't think you have any questions about their business model. The other thing I was going to mention, I know it was cable. So that's one. Again, the bonds haven't, I don't think, gotten into distress levels yet. But what's the substitution for cable these days? It's streaming. So my daughter recently moved into her own place, and I asked her what cable provider she was going to get. She was like, "Mom, nobody gets cable anymore. I'm going to just do Netflix, etc." And so you have what you call cord nevers, people who didn't just get rid of their cable. They never signed up for cable or satellite. So what you're seeing with AT&T, which owns DirecTV, is real deterioration in their number of subscribers. And so those bonds have not gotten to distress levels yet, and it may be a long time before they do, if ever, because obviously AT&T has other businesses, but that's a business that, where the equity could be hit. AT&T is a little different because it's doing something else. It owns DirecTV, but obviously AT&T has a whole nother business and, mobile and blah, blah, blah. But
Sure.
That's another industry where you go, there's something fundamentally going on here with this business. And so the bonds haven't gotten distressed yet, but once they do, it will probably, once bonds get to 30, it's way too late to buy the equity. The equity may be trading at $2, but you wouldn't want to touch it because it's going to get wiped out.
Right. Interesting. Have you looked at any of the industries that actually have been hit, but there might be, some good businesses just being thrown out with the junk? Like say like in the, the theme parks or, retailers or malls or airlines, anything like that?
Yeah, so I probably wouldn't be quick to jump on, names like Six Flags or cruises or airlines, just because a couple of things. I think it's going to take those guys a lot longer to pop back than a Starbucks. Starbucks
Right.
is something that even, if you've lost your job and you're paying catch up, you still have a couple of bucks for your favorite latte. So it's not a high ticket item. It's a, consumer discretionary, but one that's very cheap. And I think our need for socialization is going to drive people back to the Starbucks of the world. So that's a little bit different than paying, $200 to go to Disney or paying, $1,000 to go on a cruise. So I think those guys, the airlines, the cruise ships, the hotels are going to come back a lot more slowly than something like a Starbucks, which is one reason I liked Starbucks despite, its leverage. And so those, I think the other thing is because of their high fixed costs, they're much more likely to have liquidity issues. If you're an airline and you got, tons of aircraft just sitting there, that's a problem. And so industries that look like they may need a bailout, I'm not as enthusiastic about, not because I don't think they will come back, but I think, you could have some issues where they don't come back and they don't come back as fast. The kind of thing that I would be thinking about, either the things that are, and I don't think these are defensive, but things, look, for me right now, there's stuff that's cheap enough that I don't have to take the business risk. You know what I mean?
Exactly.
So you have
Completely.
business risk. And so there are things that I don't have. So Take-Two is something that I'm involved in. They make video games.
Sure.
So it's not something where I have to take business risk. Home Depot, I don't have to take business risk there. You know what I mean? If interest rates stay low, there's always going to be, and that's pretty beaten up. I think that one, I can't remember where it was. I know the high on the stock was close to 250. Right now it's like 180, something like that. Disney, the only reason why I'm not concerned about that is because they have their streaming business. Theme parks, I think, is only about 30% of sales. And so their streaming business is, it's nowhere near 30% of sales now, but they have enough other stuff. They have their content, they have all of that other stuff. So I think there's enough stuff going on there that they'll be fine. Amazon, I don't have to take any business risk there. And some of those things are not as cheap, but they're way cheaper than they were. Square is another one that's been beaten up. I think the high tick on that was like 87, and it's down by like 50%. It's about 44 right now. And so that's another thing that I'm in and I like, because basically your retail is going by the wayside, but when it comes back, that, their usage will come back. And so I think in this environment, it's just, there's too much stuff where there's not that much business risk, where you might as well say, rather than take, and look, I'll get a bigger reward for it if, I buy, Royal Caribbean equity, or if I buy, name some United Airlines equity, I'd get a bigger return for it eventually. But I also have, risk versus return. I also have, commensurate risk, because, it wouldn't be inconceivable that one of those companies could file if the government bailout isn't enough for them. So for me, there's enough stuff where I say, there's not as much business risk, and it's already beaten up, I'd rather do that than take the business risk on something like, United or Royal Caribbean. Why bother when I can make a lot of money doing stuff like Take-Two or Home Depot or something like that. One name I looked at recently, and I'll just throw this out to people, and I'm not involved. I didn't get involved, but it's a jeweler called Signet Jeweler.
Okay.
And they basically own Kay Jewelers. They own Zales, and they own Jared. And that's a tough one. I would not necessarily recommend it to people. There are pros and cons there. They have huge market share. Before I looked at them, I didn't even know that Kay and Zales and Jared were all owned by the same person. And 50% of their business is bridal related. So you got kind of a core there. Like if you live in the New York area, you can go down to the Diamond District and buy your girlfriend's engagement ring. But, in other parts of the country, you end up at Zales or Jared's or whatever. And so they've got huge market share. 50% is bridal. That's not recession resistant, but people are still going to be getting engaged. It's not a discretionary purchase. Purely, you can delay an engagement, but when you're ready to do it, you got the cash burning a hole in your pocket. If you get married, you need rings. But the problem is they're in malls, and mall traffic is declining. So some of that traffic is going to go to a mall anyway, because it's a destination. Like they're going to go to the mall because they're looking, they have to go get that wedding ring. But Valentine's Day purchases and other things where I'm just wandering by and I see a nice watch. I don't know. So that's one that I looked at. Kind of was, 6 one way, half a dozen the other on it, didn't get involved, may get involved later, don't know. But that's the kind of thing that you're dealing with now with some of these equities that are really beaten up. The business model is questionable, because the fact that mall traffic is down and continuing, I think it was down 4% last year, and it's continuing to decline. It's not an easy thing to make a bet on. So, and, that's what you get. So the company doesn't have a lot of bonds, and I'm not sure where the bonds are trading. I was looking at the equity, but, people were recommending the equity last year in the 30s. I think at the end of the last year, it was in the 20s. Now it's at 6, and again, I think a lot of that is people are concerned about the business model. And then they're in malls, they have leases. So all the stores are closed, the malls are closed. So do they continue to make those lease payments? So I think they have.
What do you think's going to happen
when that business pops back again? I think the bridal business will come back, but I guess what I'm saying with this particular one, I don't know. And again, it's not because it's a pop back like I think. And I keep referencing Starbucks. I can't think of anyone other, off the top of my head other than Starbucks. But, Square, I guess, is another one. But I think it's not a question of when they're going to pop back. I think it's a question of if they're going to pop back. And that's kind of what separates some of the equities that we have seen been beaten up just because the market is down, and some of the equities that we have seen being beaten up because there's a problem with the business. And so I don't know. I couldn't recommend that stock to you because I just don't know. And it's not because, look, I think the bridal business comes back, but that's half the business. I'm just not sure the future of malls. And we've been talking about that for years now. As more and more people shop online, what is the future of a mall? And so I'm hard pressed to say to somebody, go run out and buy that stock, because there's something else going on other than just the recession. And so they've got to get through the recession, but like, iHeartRadio, like Senveo, like, newspapers, it's not just the recession, it's something else is going on. And so I think that's what you have to be careful about with some of these companies that are really beaten up. And like I said, it may make more sense to put money into something else that's down 30% than, something that's down 50% or 70%, because the fact that it's down 50 to 70% kind of lets you know there's something else going on here other than just COVID.
Right. Very interesting. I don't know, is there anything else you want to talk about or bring up before we wrap it up?
No, the only thing I would think is two things I wanted to mention.
Yeah,
we have some upcoming courses. One is for beginning investors, and just how do you buy stocks in a bear market. I think you and I probably would agree. I still think the market, the bear market is a great buying opportunity, particularly for millennials, because you can buy cheaper, stocks that were much more expensive 6 months ago. You can buy them, and if you're a millennial and you buy them, over time, so your average cost is lower, you can hold on to them for 5 years. You're not looking to retire. You may not need the money for a while. So I think, Warren Buffett has a quote that says, every 10 years, the skies turn dark and the heavens rain down gold. And if that's the case, you should go out with a wash bucket, not with a teaspoon. So I think it's a wonderful opportunity. Look, everybody can't flip real estate. Everybody can't doesn't want to do a side hustle, but pretty much anybody, especially with mobile trading apps, can buy stocks. And so we have a course for novice investors that's going to launch next week. And then I'm also going to be doing one for more experienced investors, just because I think the traditional equity ratios like price to earnings and that kind of stuff may fly out the window soon, just because, I'm like talking to people who do what I do, and they're like, okay, how do you value this stuff? If I'm already in Disney, I can say, okay, I'm gonna buy more because I'm buying it at a discount to where I was buying it last year. But if I'm looking at something like, Signet Jewelers for the first time, how do I value that? Because multiples are all over the place. I don't know what EBITDA is going to be this year. There's a lot more uncertainty there. And so there's some things that, value investors, experienced value investors, should be looking at, like credit lines and upcoming maturities. And so we're going to delve into that a little bit. So if you're interested, go to MilleMoney.com and you can subscribe, and we'll let you know when those courses are coming up. But I think, despite my reticence to recommend, any particular distressed bonds or to really come out, for a distressed company like Signet Jewelers or anything like that, I think it's a wonderful time to be an investor. I think you can create a lot of wealth for yourself. And, I think you have to be wise about it, do your homework on the balance sheet, buy good companies, with good balance sheets at good prices, be prepared to buy and hold. But I think it's a wonderful time to be an investor and to create wealth for yourself. And what I will say, which you well know and most of your listeners know, it's one of the few things you can put a couple of $100 into, and it's going to be worth more. There's a really good chance it's going to be worth more in a couple of years than it is now. If I buy a new iPad, if I buy new shoes, they're going to be worthless in 5 years. But if I buy 500 of, I don't own Apple, but $500, of Apple, it's going to probably be worth more in 5 years than it's worth now. And there's not a lot of things you can say that about other than stocks. So it's a great time to be an investor.
Yeah. All right. Well, Shelly, I really appreciate you coming on, and stay safe.
You too. Thanks.
All right. Thanks. Take care.
Okay.
Bye.
Thank you for listening to the Intelligent Investing Podcast with Eric Schlein. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.